Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 26th of June 2021. And earlier, just a couple of hours earlier in fact, we published our gold and silver weekly update for the week ending the 25th of June, highlighting that there could be consolidation ahead for gold and silver prices. Now the reason we're putting up a video this evening is that we've literally just read an article published by Bloomberg suggesting that we may very well see an end to central bank and government support sooner rather than later. I am, of course, referring to stimulus support rather than anything else. So we thought we should alert you to this and share with you our comments of this article. So, if you have a spare 10 minutes or 15 minutes, then let's take a look. Well, we've just come across an interesting article published by Bloomberg just 2 hours ago. Headline, Peak Central Bank Support Marks New Phase for Global Recovery. Now, we've discussed the whole issue this past week in our daily updates as to whether, of course, based on what was said a week last Wednesday by Jerome Powell, the chair of the Federal Reserve at the FOMC meeting, about the prospect of tapering back on their QE program, or at least having talks about the potential of tapering back, and highlighting that interest rates were likely to rise at least twice in 2023, with some FOMC members favouring a rise in 2022. Now, against that, we have the United Kingdom more or less stating that it expects potentially to taper sooner than later, which has caused the pound to rise a little against the dollar. But the European Central Bank basically ruling out any form of tapering for the time being and riding the wave of increased euro printing. So the whole issue is now, what basically is the Fed going to do? Because at the end of the day, we all know that when America sneezes, the rest of the world catches a cold. So what are they going to do? What are they going to really base their decision on? And what are some of the influences that are going to perhaps push the Fed into one direction or another? Now, let's just run through this Bloomberg article and we'll discuss it as we go through it. The pandemic recovery is in a new phase as multiple central banks start or plot the withdrawal of emergency stimulus, gradually shifting from peak support and opening up divergences in international policy making. The Federal Reserve's crab walk towards the moment it reduces its aid has cemented the global pivot, with counterparts in the UK, Canada, Norway, Sweden, South Korea and New Zealand among those sketching out maps to a pullback. China's central bank has already switched gears and is focusing on controlling debt while ensuring those parts of the economy that still need liquidity get it. Just last week, Mexico, Hungary and the Czech Republic raised interest rates, following hikes earlier in 2021 from Brazil, Turkey and Russia. Now let's just stop there for a moment, because we've come across a number of pundits, particularly on YouTube, telling us that there is absolutely no way the Fed can raise interest rates ever. They've been saying that since the 2008 financial crisis. It is hogwash and rubbish. The Fed can raise rates. Wouldn't be a good idea at the moment, but just because the American national debt is in the late 20 trillions does not mean it couldn't go up to 30 trillion or 32 trillion or 35 trillion if necessary. Not a good idea long term. Ultimately, it has to be paid for. But it can raise rates and pay the interest on that debt by printing even more currency. Now, we all know that long term what effect that will have. They believe, however, Through the adoption of stimulus and what we have termed now for the past, frankly, 18 months, modern monetary theory, they believe that the economy can pick up so that eventually it can slowly start to pay down the debt. We're not convinced they can pay it down, but we're certainly convinced that providing the global economy picks up, they can earn enough revenues to ensure at least when they do raise rates, the interest rate can be paid. But don't listen to those people who say rates cannot ever go up. It's rubbish. They said it, as I mentioned, in 2008, and what happened later in the 2010 decade? Rates went up. Now, albeit not a lot, I think 2.5 percentage points. They were hoping for 3, couldn't quite make it, and then they had to reduce them again. But don't believe it'll be 0. And the way the international money markets work anyway, in any case, even if the Fed doesn't raise it, they will rise naturally. Now, the policy turn is still expected to be slow, as the ongoing spread of COVID-19 variants complicates a return to economic normality. And most policymakers contend inflation surges will fade. Okay, that's debatable. That is debatable. Though we have to confess that with restrictions on supplies at the moment because of the COVID lockdowns, of course prices are going to be potentially artificially higher than they should be. As those lockdowns ease and there is more fluidity in international transport, then one would expect prices to begin to fall. Whether they'll fall, of course, to the Fed's prescribed 2% level, that's another matter, and that's for another debate. The European Central Bank and Bank of Japan are signalling they'll maintain their easy money settings. So you have certain parts of the world going to continue with easy money, and other parts of the world saying they're not going to continue, or at least they'll continue with it, but it will not go on as long as originally forecast. And as we've already mentioned, there are some countries that are already raising interest rates. All told, JP Morgan Chase & Co. economists estimate the average global interest rate will rise only fractionally through the rest of this year to 1.28% from the current 1.27%. We wouldn't argue with that. How the transition plays out will nevertheless be a crucial test for the global recovery and markets. Move too fast and central banks risk shaking investors, hurting confidence and stalling the rebound. Agreed. Go too slow and they could stoke inflation and worsen financial stability as house prices and other assets surge. Agreed, leading to one almighty crash. After acting in unions to reverse the recession as the pandemic hit, authorities moving at different paces also carries implications for markets. Last week in the euro area, for example, stocks gained and bond yields stopped rising on bets the ECB will lag the Fed. And this is what we raised in our videos last week and at the end of the week before. The shift beyond peak monetary stimulus coincides with signs the global rebound may moderate as massive government spending fades and China's growth slows. Although President Joe Biden is planning further large-scale fiscal stimulus for the US, it's expected to be rolled out at a slower pace. Quote, the global rebound will start to slow as the impetus from monetary stimulus, along with reopening and fiscal stimulus, starts to fade, unquote, said Shane Oliver, chief economist at AMP Capital Investors Limited in Sydney. Now, optimists, and this is what the government's hoping for, say there's enough momentum in the recovery to withstand any central bank tapering, and that an outright tightening of financial conditions is still a long way off. COVID-19 vaccination rates are accelerating and continued fiscal stimulus will support growth, as will the unlocking of trillions worth of pent-up consumer demand. And that is indeed potentially accurate. Fed Chair Jerome Powell said Tuesday that policymakers will be patient in waiting to lift borrowing costs. Now, bearing in mind he was talking about tapering, now this week, because he saw the effect that had on the equity markets, and it was quite profound for a couple of days, they're going to be patient. And the US Central Bank has still to detail when and how it will begin paring its asset purchase program, which would be the first step. Monetary tightening is likely to be gradual, said Mansoor Mohiuddin, chief economist at the Bank of Singapore Limited. If the Fed and other major central banks keep convincing investors and the public that this year's surges in inflation, as economies reopen, will only be temporary, then monetary conditions are likely to stay loose for the next couple of years. History shows that managing the exit won't be easy. Attempts to wean markets off a drip feed of cheap liquidity in the years after the global financial crisis spooked investors, and we remember that. That reliance on official support is evidence from the explosive acceleration of central bank asset purchases. Chris Marsh, a former IMF economist who's now a senior advisor at Exant Data, calculates that balance sheets for G10 central banks grew by $11 trillion between Feb 20 and May 2021. That kind of growth took 8 years to reach in the period following the financial crisis. Speaking at the Qatar Economic Forum, billionaire investor Ray Dalio said he expected the Fed to achieve its desired results with relatively modest actions, though he also flagged concerns about how markets may respond. Now remember, Ray Dalio is a great advocate of gold. It's easy to say that the Fed should tighten, and I think that they should, said Dalio, founder of Bridgewater Associates, the world's biggest hedge fund. But I think you'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very, very long. In other words, we should have had a crash a long time ago. But this continued spending has ensured that that crash has not occurred. Many are therefore advocating that all that's going to happen is that when we do have a crash, it will be bigger and more devastating than it would normally have been. We have to wait and see whether that actually occurs. Those who believe in modern monetary theory, and we're not necessarily one of them, other than the fact that we do believe that MMT delays the ultimate reaction. In other words, you can go on for a reasonable amount of time, continuing to print, continuing to borrow, especially if you are the world's reserve currency. Not if you're some tin pot dictatorship with just selling sugar beet as your only source of income. We're talking about the world reserve currency who already dictate markets. For now, the US recovery and potential for a faster expansion in Europe and Japan gives central banks a window to reduce emergency support, said Alicia Garcia Herrero, the chief economist for Asia Pacific at Natixis. Monetary policy support has peaked, she said, and rightly so. We are on the path to reducing the level of support we're going to get, both from governments and from central banks. What is crucial is the speed of that withdrawal and the extent to which eventually interest rates will be raised. Meanwhile, institutions will gorge on cheap money and the public will spend, those who've received it that is, all these stimulus checks they have recently been given. Thank you for listening. Do let us know what you think about this article, whether you agree or disagree. But either way, we'd be very appreciative if you'd give us a thumbs up, subscribe, press the bell sign, and have a great remainder of the weekend. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.